Okay. Thank you. Hello, students. Good morning. Uh, there was some glitch. That's why some delay has happened in joining. Okay, so the topic for the day is India's 105 non-current assets held for sale and discontinued operations. So I hope you must have had, the class, LVC class. You have attended that, and you must have studied the concepts in detail uh, in that session. But I would like to revise key concepts quickly before we jump into the practical questions of the topic. So with that agenda, so let's start. So give me a second. Okay. So what India's 105 is all about? So India's 105 is altogether a new standard. So there is no corresponding accounting standard in our Indian gap. For 105. So 105 specifically deals with one situation where there are certain non-current assets which are held for sale, or if the company or business is discontinuing any of its operations, then how the measurement and presentation requirements, would be required for these two items. So non-current assets held for sale and the discontinued operation. So these are the two items which are dealt by this standard specifically, right? So what do we mean by non-current assets held for sale and discontinued operations in first place, right? So non-current assets held for sale, for example, if the company is planning to, sell any of its division, or vertical, or any of its subsidiary, or any of its plant, factory, right? So all that comes into the coverage of this standard. So whenever there are certain criterias or conditions prescribed by this standard which are met, then only we will conclude that yes, these are the non-current assets which are held for sale by the company, right? So once those criteria or conditions are met, then the standard says, because the company is not intending to continue with these assets in the future, right? So they are not planning to use these assets for their business purposes anymore, and hence these demands a separate measurement and separate presentation on the face of the balance sheet, along with some explanatory notes, so that users of the financial statements will be able to understand and comprehend that how the management is seeing their assets, right? Or these assets, right? So since these assets ideally would have been part of our property, plant and equipment, or intangible assets, or the investment property until now, but now because the management is intending to sell them, right, and they are not intending to continue with these assets anymore for the purpose of their business use, so that's why this requires a separate measurement and the presentation, right? Just to demarcate that these are the assets which the management has identified for selling in the near future, right? So that's the core objective of the standard, so that users of the financial statements will be able to comprehend the financial statements in a better way and understand how the management is proceeding with the use or discarding of certain assets, right? So that's the core objective. Now, as I clearly said, that this standard is only applicable for two items, right? So the non-current assets which are planned or held for sale, and the discontinued operations which are discontinued by the company, right? So standard says that whenever we land up in such a situation, then we need to identify all these assets group and remeasure all those assets group on the date of such classification at a lower of the amount which is appearing in my books of accounts on the date of classification. That is called the carrying amount, and the fair value less cost to sell, whichever is lower, right? So we will be measuring the fair value less cost to sell for all these assets group, and then we will be comparing that fair value less cost to sell with the carrying amount in my books, and whichever is lower, at that value I will remeasure these assets, right? So that's the uh, requirement triggering from the standard, right? So let me quickly increase the size. Okay. So first of all, there are certain criteria which needs to be met in order to classify these items as held for sale, right? So there are certain criterias. Then once those criterias are met, then only we will say that yes, these are the assets group which are held for sale, or these are the operations which the company has discontinued and hence meeting the criteria. So 105 triggers. Once the 105 triggers, we will remeasure the assets which are held for sale, right? Like I just mentioned, that the lower of the carrying amount or the fair value less cost to sell, right? Once I remeasured, then it also asks us, this standard also asks us to present these items, separately. So separately means these needs to be separated from the other property, plant and equipment, intangible assets or the investment property, which the company still has and would be continuing to use them, right, in the future, right? And then once the presentations measurement is done, presentation is done, certainly there would be certain additional disclosures related to these aspects so that users will be able to comprehend these, presentation and measurement better, right? Now, as I said, 105 is applicable only on two items, right? Accounting for non-current assets held for sale or the disposals groups and the discontinued operations, right? In these cases, measurement will be at the lower of the carrying amount and the fair value less cost to sell, right? Once I measure the carrying amount on the date of the classification, so certainly I would be needing to adjust whatever the depreciation or the impairment, is there, if any, needs to be adjusted before, I go and compare that with the fair value less cost to sell on the date of the classification, right? Once asset is successfully or classified as non-current assets held for sale and discontinued operations under Ind AS 105, then standard says now depreciation will no more be charged on this group or this disposal group anymore, right? So until the group is disposed of, there wouldn't be any depreciation or any impairment would be charged on these items, right? So cessation of the depreciation once the classification is done, right? So as and when any of the property, plant and equipment or intangible assets or investment property or any other assets part of this disposal group is classified as non-current assets held for sale, right? Then standard says we will not be charging the depreciation anymore on these assets, right? So until now we were charging the depreciation, but after such classification, there wouldn't be any depreciation expenditure on these items. And at each reporting date, until these items are sold, it will continue to be remeasured at each reporting date at fair value less cost to sell, right? So I hope this is clear. Any questions? Okay. Now, while the 105 specifically talks about to remeasure these items at fair value less cost to sell, but there might be certain items which may be part of this disposal group. For example, deferred tax assets, assets arising from employee benefits, financial assets, non-current assets, which are measured at fair value less cost to sell under Ind AS 41, right? Agriculture standard you must have already read, right? And the contractual rights under insurance contracts, if any. So because all these items have their specific standards for their measurement basis. So this standard doesn't want to, confuse, and hence this standard specifically says that 105 does not apply in terms of the measurement provisions for these items, right? So these items, which items? Item number one, deferred tax assets. Item number two, assets arising from the employee benefits. Item number three, financial assets. Item number four, non-current assets, which are measured at fair value less cost to sell under Ind AS 41, that is the agriculture. And the insurance contractual rights, right? So all these 5 items are out of the measurement provisions of Ind AS 105 if they are part and parcel of that disposal group, right? So that disposal group certainly would be measured at fair value less cost to sell, right? But in order to measure the fair value less cost to sell, if any of these items are part of that asset group, then these items continue to be measured under their respective standards. That is Ind AS 12, 19, 109, 41, and 104 respectively, right? So measurement provisions of 105, that is fair value less cost to sell, will not apply to these 5 items. All other items will anyway be measured as per 105. Is that clear? And what is the rationale behind this? Because certainly nobody can come up and say that this is the fair value less cost to sell for the deferred tax asset, right? So deferred tax assets are basically, the advantages which the company would be reaping in the future, right? So these are not as such those tangible or intangible assets which we are talking about to measure at the fair value less cost to sell, because there is no cost to sell and there is no fair value for the deferred tax assets, right? So and hence they will continue to be measured under Ind AS 12 only. Same thing applies for the other items, right? Okay. Now, as I previously said, that there are certain key requirements or the criteria which needs to be checked, and if they are met, then only we will conclude that these are the assets or the non-current assets which are held for sale and discontinued operations for the disposal group held for sale, right? So what are those criteria or the conditions? So let's quickly revise those as well quickly. First of all, the condition is whatever the management is planning or identified, to sell, they are available for immediate sale, oblique distribution, and it is not conditional that if certain conditions are met, then only the management will decide to sell these non-current assets, otherwise not. Or if they would be sold on meeting certain, criteria or conditions. So if there are any, then it means that is not available for sale. And once it is not available for sale, it cannot be regarded as held for sale under 105, right? So it has to be available in its present condition, right? In its present condition. Then management is committed to plan to sell or distribute these assets, right? So how do we see the management is committed, right? So management commitment, uh, uh, is verified by the resolution if the board of directors have approved the plan to sell these assets. So if there is any resolution which is passed in the board meeting where the board of directors might have approved the same, right? Yes, we are all okay to plan to sell these assets, then it shows the management's commitment to this. Until then, we cannot say that management is committed, right? So these are the evidences or the proofs which will substantiate the commitment of the management, right? Then management must have started, an active program to locate the buyer so that this sale transaction can be completed, right? So it is not that management has decided to sell something, but it is sitting on the couch waiting for, something to happen on its own, right? So it has to be efforts which management needs to put in order to, get the sale completed, right? So what are those efforts? For example, advertisement in the newspaper or in the media, or hiring some third party marketers who would be able to find the buyer for the company's assets, right? So somehow management needs to demonstrate that yes, they have started or they are actively locating the buyer to make the sale happen, right? Then asset is actively marketed for sale at the price that is reasonable. For example, if the management the fair value of the non-current assets which they are planning to sell or intending to sell, is say 100 rupees, okay, for example, but they want to sell this at say 150 rupees, then do you think they will be able to find the buyer? No. So because they are trying to sell it at exorbitantly high price as compared to what the reasonable or the fair value of the asset group is, then it can be concluded safely that they will not be able to find the buyer, right? And the sale will not be concluded, right? Because nobody, no prudent person will be buying anything, at an exorbitantly high price as compared to what the true value of the asset group is, right? So if 100 rupees worth of assets are being planned to sell at 150, then it is exorbitantly high and the sale will not happen. That is clear, right? So the condition is it should be, marketed at a reasonable price in relation to the current fair value of the asset group, right? So whatever the current fair value of the asset group is in the market, it should be, reasonably placed, whatever the company is desiring to fetch by selling these assets, right? Then sale distribution should be expected to qualify for a recognition as completed sale distribution within 1 year from the date of the classification. Now, the condition is, although this is not a very strict condition that it has to be within the 365 days, right? It might be 1 month plus minus or 2 months plus minus, but it should reasonably be concluded within the 1 year from the date of such classification or from the date of such decision is made by the management, right? So that's the expectation, because we cannot hold on anything for such a long period that we are simply waiting for something to happen and it is not happening and years are just passing by, right? So that situation will lead nowhere, right? So that's where standard has precisely said that it has to be completed within 1 year from the date of the classification, right? And the last, it is unlikely that significant changes to the plan will be made for the completion of the plan sale distribution, or uh, plan distribution should not be withdrawn. So the last condition is that management should continue to be committed to make the sale happen rather than thinking otherwise or planning it to withdraw this sale plan in some time, right? So they might have came up with the idea to sell these assets, but later on they are planning to withdraw it, right? So that shouldn't be the case. So these are the 6 conditions or 6 criterias which we need to, be learning. And once all these 6 conditions are met, right, then only we will be able to conclude that yes, these are the assets group or these are the non-current assets which are held for sale, and meeting the criteria, they would be classified as non-current assets held for sale under Ind AS 105 separately, right? Any questions? Okay. So those were the key concepts about Ind AS 105. Now, sometimes it happens that management was sincerely planning to sell these assets, but sale is not concluded, and now the management is reversing their decision to sell them, and they are changing, the classification back to the normal assets like PP&E, right? So in that case, what would happen? So standard says in the rarest situation, whenever the management withdraws any such sale plan for any of these non-current assets held for sale or the discontinuing operations, so what would be the accounting and measurement requirements in that case? Although that is not promoted by the standard, because the precondition of the standard is that management is not withdrawing this, but in the practical life situation, there could be certain situations where actually management, is now withdrawing with the plan, right? So in that case, the standard says, because we were measuring all these non-current assets held for sale at fair value less cost to sell at each reporting date for since the date of the classification. But had we not planned to sell them, we would have been measuring them at carrying amount, which would have been the cost minus depreciation minus impairment until today, right? So the standard says we need to calculate that carrying amount which otherwise would have been reflected in the books of accounts today in case this decision was not taken earlier to sell them, right? So what would have been the carrying amount in that situation? So the original cost minus the depreciation and impairment throughout the life until today, right? So that is the measurement which we will be making, and then we will be comparing this measured amount with the recoverable value or the recoverable amount on the date of the subsequent decision of not selling these assets anymore, right? Once both the measurements, that is the carrying amount minus depreciation minus impairment until now, which otherwise would have been reflected in the books of accounts had this decision was not taken, and the recoverable amount, then the lower of these two would be regarded as the today's value of these assets at which they will be reclassified back to the original PP&D or intangible assets or the investment property as the case may be, right? So in that case, we will reclass this non-current assets held for sale back to the normal assets, and the measurement would be the lower of the would be carrying amount with, and the recoverable amount on this reversal decision date, right? So this would be the measurement basis, and thereafter the assets will start assets will resume the depreciation and impairment going forward anyway under their respective standards 16, 38 and 40, whatever it is, right? Now, in terms of the presentation requirements, what are the specific presentation requirements for these non-current assets held for sale and the disposals groups? So standard says present a non-current asset classified as held for sale separately from other assets in the balance sheet, right? So we need to demarcate that which all assets we have planned or we are planning to sell them, right? Separately from all other assets which the management is continuing to use for the business purposes, right? So we will be presenting this non-current assets held for sale or the disposal group separately from other assets in the balance sheet. Similarly, the liabilities of the disposal group, which are classified as held for sale because they are pertaining or related to the assets which are classified as held for sale. So those liabilities will also be forming part of this disposal group only. So they should also be separately presented from other liabilities in the balance sheet, right? Although they should not be offset to present a single amount. So we would be presenting gross, that is the assets held for sale and the liabilities related to this disposal group, right? So we wouldn't be presenting the net amount anyway. That's the prohibition by the standard. Now, separate disclosure is required for the major class of the assets and liabilities classified as held for sale. So whatever the major assets or the liabilities are forming part of this disposal group, that needs to be disclosed separately, right? So there is a separate detailed disclosure required on these items, which all items are forming part of this group of assets. And then we will be presenting separately any cumulative income or expenses recognized in OCI related to these non-current assets held for sale. So if there are any income or expenditure incurred by virtue of these assets held by the company for sale, so those also will be presented separately. Comparative amounts are not reclassified because this is the decision taken in the current year. So only the current year reclassification will happen. For the comparative prior periods, we wouldn't be doing any such reclass because until that year, these assets were not held for sale, right? So this is the current year phenomena only, and it was not there in the last year. So last year, reinstatement or reclassification of these balances is not the requirement. And once any gain or losses on the remeasurement does not meet the definition of discontinued operation shall be included in the P&L from the continuing operation. So if there are any remeasurement gain or loss of these assets, right? So that is not part and parcel of the income or loss from the discontinuing operations that continue to be forming part of my continuing operations gain or loss other income, right? Key disclosures. So we will be telling neatly in our notes to accounts that what is the description of these non-current assets, right? What are the nature, place, location of these assets, and the facts and circumstances of the sale leading to the expected disposal. So why the management is planning to sell them, what led management to decide to sell them, right? So those facts and circumstances needs to be explained in the notes to accounts. Gains and losses recognized, if any, and presented separately on the face of the income. That also needs to be, disclosed in the disclosures. And the reportable segment to which these disposal group part of, so that segment name or the reportable segment name needs to be disclosed in the notes to which it is a part of. And if there is any change to plan to sell these, then what are the facts leading to that change, that also needs to be explained. So these are the key disclosures required by the standard. So that was it on the quick recap or the revision of the standard. Now maybe we can deep dive into the practical questions. But before that, if there is anything anybody wants to ask, I'm happy to answer or take the queries. Okay. So this is the question number 1. So following is the extract of the consolidated financial statements of A Limited for the year ended as on 31st March 2001, right? So there are certain assets and liabilities which are stipulated in the table below, right? And all the amounts are in thousands. So what are those items? Attributed goodwill, intangible assets, attributed goodwill, intangible assets, right? Financial assets measured at fair value through other comprehensive income, property, plant and equipment 1100. So all the amounts are in thousands. Deferred tax assets, current liabilities, non-current provisions, and the total 2250, right? Then on 15th September 2001, management decided to sell the business. It noted that the business meets the condition of the disposal group classified as held for sale on the date in accordance with Ind AS 105. However, it does not meet the conditions to be classified as discontinued operations in accordance with that standard. The disposal group is stated at following amounts immediately prior to the reclassification as held for sale. So carrying amount as on 15th of September 2001 are also given in the question. All the amounts are again in thousands, right? So all these items values are the carrying amounts on the date of this decision to sell, right? Entity A proposed to sell the disposal group at 1900, right? 1900,000. It estimates the cost to sell is 70,000. The cost consists of the professional fees to be paid to the external lawyers and the accountants. At 31st March 2002, there has been no change to the plan to sell the disposal group of the and the entity A still expects to sell it within 1 year from the initial date of the classification. Mr. X, an accountant of the entity A, remeasured the following assets and liabilities in accordance with respective standards as at 31st March 2002. Financial assets, deferred tax assets, current liabilities, non-current liabilities provisions. So all these items are remeasured at these values, right? The disposal group has not been trading well and its fair value less cost to sell has fallen to 1650,000. Okay. Compute the value of all assets and liabilities within the disposal group as on the following dates in accordance with Ind AS 105. So first of all, we need to calculate the value of all these assets on 15th of September 2001 and then on 31st March of 2002, right? So that is the ask from the question. So I'm just giving few minutes in case anybody is trying on their own, just to see if you are able to do this solution. Okay. So let's see how we are going to measure these items on 15th of September 2001, right? So first task is to measure the value of the disposal group on 15th of September, right? On the date of classification itself, correct? So the disposal group should be measured at the fair value less cost to sell, right? 1830, right? And the impairment write down of rupees 330, that is 2160 minus 1830, should be recorded in the P&L from the continuing operations, right? Now, why this measurement? Because the standard says it needs to be measured at the lower of the carrying amount and the fair value less cost to sell. So fair value less cost to sell is given in the question. So this is the fair value and this is cost to sell, right? Given in the question, right? So 1,900,000 minus 70,000, right? So 1830 would be the fair value less cost to sell, simply given in the question. And because the carrying amount is 2160, which is also given in the question, so 2160 minus 1830 would be the 330. That would be the basically impairment which we need to record in the P&L. So 330 should be allocated to the carrying values of the appropriate non-current assets, right? So that allocation, anyway, we know how to do that, right? So we would be taking up the carrying values which are given in the table in the question itself, right? On the 15th of September. So these are the carrying values, right? Of all these items. And the total loss of 330, we would be allocating to these items, right? So first of all, the rule says that if the goodwill is there, then first of all, goodwill will be eliminated in full, right? To absorb the maximum impairment loss, right? Once that is done, and if there is anything remaining, that will be allocated on a pro rata basis to the respective carrying values of other non-current assets sitting in that group, right? So which other non-current assets do we have in the group apart from the goodwill? So goodwill we have eliminate first, then we have the intangible assets in the group, then we have the property, plant and equipment, again the non-current asset, and then is there anything else? No. So there is nothing else. So only two non-current assets we have in this entire group. So the remaining portion of the loss will be allocated to these two items in the ratio of the carrying amounts, right? Correct. So in the ratio of their carrying amounts, the remaining loss will be allocated. So how much remaining is 330 minus 200 is equal to 130. So 130 will be splitted into 62 and 68 in the ratio of 930 divided by 930 plus 1020 and 1020 divided by 930 plus 1020, right? So in that ratio, this calculation anyway you will be able to perform. And once these amounts are, applied, so the revised carrying amount we would be computing. So for goodwill, it will become nil, right? And for all these items, this would be the revised carrying amounts, right? So that was the ask one in the question. The impairment loss is always allocated first to goodwill, and that we have been, reading since ages, right? So we shouldn't be mistaking in that anywhere, right? So if the goodwill is present, that has to be removed completely first, and the remaining loss only will be allocated on a pro rata basis to other assets of the disposal group. And which other assets are we supposed to allocate this to? All the assets remaining? No, only to the non-current assets. For example, intangible assets, for example, a property, plant and equipment, and so forth, right? So current assets like current assets, current liabilities, financial assets, financial liabilities wouldn't be taking it, right? Anyway, following assets are not in the measurement scope of the standard, that is financial assets measured at other comprehensive income, deferred tax asset measured under Ind AS 12. So all these items will continue to be measured basis on those respective standards, guidance, right? So that was the part one to the question. Now let's proceed to the part two. Now we need to recompute the balances at 31st March 2002, right? So all of the assets and liabilities outside the scope of the measurement under Ind AS 105 are remeasured in accordance with relevant standards, right? So whatever items which are outside the scope of 105, which items? 5 items, which we have, discussed in today's session again, right? What were those? Income tax assets, right? Plan assets coming out of employee benefits, right? Any assets forming part covered under Ind AS 41 agriculture, right? Financial assets measured at fair value, right? In accordance with Ind AS 109, right? So all these items are outside the scope of Ind AS 105 and the insurance contract, which anyway is not applicable, right? In our case. So the assets that are remeasured in this case under the relevant standards are the financial assets measured at the fair value through OCI, and the deferred tax asset at 12, and the provision assets and liabilities under Ind AS 37, right? So once those items are measured under the respective standards for which the amounts are anyway given in the question itself, right? So we would be taking them, and for the remaining items, we would be doing the remeasurement. So how to go about this? So goodwill, we are anyway, having no balance. So goodwill will continue to be sitting at the nil, correct? Then intangible assets. So what was the amount as on 1st of September 2001? 15th of September, sorry, 868, right? So now we'll start with 868. And how much impairment we will do? 29. So this again is the pro rata allocation of the next impairment loss, right? So how did we calculate that? So we have calculated this again with the information available in the question, right? So here it is. The disposal group has not been trading well, and the fair value less cost to sell is reduced or fallen to 1650, right? So 1650 is the final fair value less cost to sell. So there is no separate piece of information about the fair value and the cost to sell. So question has clarified that this is the fair value less cost to sell only. So this will be compared with the value which we have computed on 15th of September, right? And then we will calculate the impairment loss, right? So that impairment loss is being allocated now again on these non-current assets, because all other assets are anyway out of the scope of Ind AS 105, right? So 60 is the impairment loss calculated, which is now again allocated in the ratio of 952 and 868, right? So 868 divide by 868 plus 952, right? That's how this 29 has been calculated and applied. And these are the finally the revised balances as at 31st March 2000. So that was it. So what are the key learnings from this question? So if you would like to note down, I'm just enumerating them. Number one, the measurement basis under the standard is fair value less cost to sell, and it's not the fair value. So we need to be crystal clear that it has to be fair value less cost to sell. So sometimes we forget that it was cost to sell or not, and we simply assume that it is the fair value. No, it is the fair value less cost to sell. Number one. Number two, at the date of the classification, standard clearly said that we have to compare the carrying amount with the fair value less cost to sell, and whatever is lower, that will be the amount at which this group would be presented. So in case our fair value less cost to sell is higher as compared to the carrying amount on the date of the classification, then there wouldn't be any gain or loss, right? Because gain is not expected to be recognized, only the loss, right? But if it is lower as compared to the carrying amount, then the delta would be recognized as loss, right? And that delta would be pro rata allocated to adjust the balances of some items. Which some items? Non-current assets only, right? So inventory, trade receivable, loans and advances, deferred tax assets, all these items are unaffected by this loss, right? So that is the, again, second learning. So whatever the loss we have, we are recognizing. We are not recognizing any gain, but if there is a loss, we would be recognizing, and that loss will be adjusted against the non-current assets only among all the assets, right? On the pro rata basis of their carrying amount. Then again, on the next reporting date, we will again remeasure the fair value less cost to sell, which was anyway given in this question, right? So we will remeasure. If there is any further loss, that further loss will again be recognized and in the P&L and will be allocated on a pro rata basis on the non-current assets only. And this exercise will continue to go on at each reporting date until this disposal group or the assets which were planned or held for sale is eventually sold off, right? So that's the requirement from the standard. Okay, so I hope the question and the learnings from this question are very clear to everybody, and everybody has noted down for their future revision, quick revision. So let's proceed on the question number 2. CK Limited prepares the financial statement under Ind AS for the quarter and the year ended 30th June 2001. During the 3 months ended 30th June 2001, the following events occurred. On 1st of April 2001, the company has decided to sell one of its division as going concern following a recent change in the geographical focus. The proposed scale would involve the buyer acquiring the non-monetary assets, including the goodwill of the division, and the company collecting any outstanding trade receivables relating to the division and settling any current liabilities, right? So what is happening over here until now basis on these facts? So CK Limited is preparing the financial statements under the Ind AS for the quarter 30th June 2001. During the 3 months ended June, the following events have occurred. What are the events? On 1st of the April, company decided to sell one of its division as a going concern following a recent change in the geographical focus. So company is diverting changing the geographical focus. So that's why it is planning to sell one of its geographical location, division. The proposed sale will involve the buyer acquiring the non-monetary assets, including goodwill of the division, and with the company collecting any outstanding trade receivables related to the division. So if there are any trade receivables, the company will continue to collect them and settling any current liabilities. So current trade receivables and the current liabilities are not part of the disposal group that appears from the facts. On 1st of April 2001, the company, the carrying amount of the assets of the division were as follows. So goodwill is 60,000, property, plant and equipment is 20 lakhs, and the inventories are the 10 lakhs. So these are the 3 items which are sitting in this disposal group, right? from 1st of April 2001, the company has started to actively market the division and has received number of serious inquiries. On 1st of April 2001, the directors estimated that they would receive 32 lakhs from the sale of the division, right? So they are expecting 32 lakh to be received. Since 1st April, the market condition has improved. On 1st of August, the company received and accepted a firm offer to purchase the division at 33 lakhs. So there is an offer made by one of the buyer which the company has accepted, right? The sale is expected to be completed by 30th September 2001. And 33 lakh can be assumed to be a reasonable estimate of the value of the division as on 30th June 2001. During the period from the 1st April to 30th June, inventories of the division costing rupees 8 lakh were sold for rupees 12 lakhs. At 30th June 2001, the total cost of the inventories of the division was 9 lakh. All of these inventories have an estimated net realizable value in excess of their cost. So NRV is greater than cost, right? So that the standard has clarified. Suggest how the proposed sale of the division will be reported in the interim financial statements for the quarter ended 30th June 2001, giving the relevant explanations. So ask from the question is how we are going to report this sale in the 30th June 2001 quarterly results. So that's the question. So I'm just waiting for a minute or two for you to digest the facts and think through what would be the accounting and presentation requirements for this, and then certainly we will discuss the solution. So giving you a chance to at least think through. Okay. So let's the decision to offer the division for sale on 1st of April 2000 means that from that date, the division has been classified as held for sale as per the Ind AS 105, right? So since the management has decided upon to sell this division on 1st of April, so it means this is the item which is meeting the criteria for Ind AS 105 requiring the classification as held for sale on that very date. The division available for immediate sale is being actively marketed at a reasonable price and the sale is expected to be completed within 1 year, right? So these are the facts given in the question. The consequence of this classification is that the assets of the division will be measured at the lower of their current carrying amount and the fair value less cost to sell, right? So whatever is lower, so carrying amount versus the fair value less cost to sell, whichever is lower, that would be the measurement basis for these division assets now onwards, right? So the division shall be measured at their existing carrying amount 30 lakh 60,000 since it is less than the fair value less cost to sell of 32 lakhs which is given in the question. So fair value less cost to sell in the present case is higher as compared to the current carrying amount and hence there wouldn't be any adjustment required in this case, right? Because fair value less cost to sell is higher as compared to the carrying amount. So whatever is lower, that is the carrying amount is lower. So it will continue to be recorded at the carrying amount only, because we do not recognize the gains ever under the Ind AS 105 if the fair value less cost to sell is higher as compared to the carrying amount. The increase is expected selling price will not be accounted for since earlier there was no impairment division held for sale, right? So increase is not to be accounted for in this case. The assets of the division need to be presented separately from all other assets in the balance sheet. Their major classes should be separately disclosed either on the face of the balance sheet or in the notes, right? So what this requirement of the standard 105. So 105 says once you identify a group as a disposal group, you need to present them separately, right? Either on the face of the balance sheet or in the notes, right? So if the company chooses to present them separately on the face itself, they can do so. Otherwise, they can present it in the notes in the schedule. The property, plant and equipment shall not be depreciated after the 1st April. So I hope you remember our discussion that the depreciation ceases on the date of the classification. So until the date of classification, only the depreciation will be applied to those non-current assets which are forming part of this disposal group assets. After the classification, depreciation will not be charged. So depreciation will be ceased on this very date. So the carrying value at 30th June 2001 will be 20 lakh only, right? So what do you mean by 20 lakh and why it is so? So in the question, if we go back, so it is given here, the carrying value 20 lakh. And because our fair value less cost to sell is higher as compared to the carrying value, so we continue to carry the disposal group at the carrying value, carrying amount only. And because there wouldn't be any depreciation or impairment anymore on these items, and hence the carrying amount will continue to be 20 lakhs only for the PP&E in this case, right? The inventories will be continuing to show at 9 lakh because in the question it is given, and the division will be regarded as the discontinued operation for the quarter ended 30th June 2001. It represents a separate line of business and is held for sale at the year end. The statement of the profit and loss should disclose a single amount, the post-tax profit or loss arising of the division on the classification of the held for sale, right? So if there is any profit and loss which is coming out of this division, that will be presented as a single amount in the profit and loss. And as per Ind AS 33, EPS will also be disclosed separately. So are you able to recall the discussion you might have had in your regular class on Ind AS 33, where you have been taught that, Ind AS 33 requires to present the earning per share from the discontinuing operations and continuing operations separately, right? So that presentation requirements is triggered from Ind AS 33. So that again, we will call it out here. Now, why we are calling it out here? We were supposed to give the answer with reference to Ind AS 105 only. No. So assuming this question is coming in your examination, so examination question, is a well-rounded, question which might be requiring you to cover the various aspects of various Ind ASs all in one question, right? So since the ask from the question was how the results would be presented for the quarter end, right? So in the results, EPS presentation is also part and parcel of those results, right? So that's why we need to mention that as per Ind AS 33, EPS will also be disclosed for the continuing and discontinued operations separately, right? Because the ask was for the overall presentation of the Q3, not only at what value the disposal group or the assets held for sale would be required to be presented, right? If that would have been the ask, then probably we might skip the discussion on Ind AS 33 in this answer, right? I hope it is clear how we are how we are planning to, give our answers in the question by, comprehending the question completely, right? And we shouldn't be focusing on the standard which is under discussion, but we also need to be open to think through which all other standards application is there in the current question. right? Because we have to see all the questions from the examination point of view, right? Okay. So let's do this question number 3. Identify which of the following is the disposal group as at 31st March 2001. So this question is simply checking the concept whether we are able to identify whether this is regarded as the disposal group under Ind AS 105 or not, right? So on 21st of March 2001, XYZ announced the board's intention to sell its shares in the subsidiary company, right? So there is a subsidiary company which the company is holding. On 21st of March, company announced that they want to sell the shares in the subsidiary, or basically they are planning to sell the subsidiary, right? So selling the subsidiary is, meaning selling the investment in shares of the subsidiary, right? Alpha, contingent upon the approval of the Alpha's shareholders. So Alpha's shareholders approval is not yet obtained. It seems unlikely that the approval will be granted in the near future, and no specific potential buyer has been identified. So first of all, the sale is dependent on the approval from the subsidiaries shareholders, number one. Buyer is also not identified, right? And it is also unlikely that the shareholders will give their approval in near future. What do you think? Whether this is meeting the criteria laid under Ind AS 105 for classification this subsidiary as non-current asset held for sale? What do you think? So what were the 6 conditions which we have discussed? It has to be available for sale in its uh, current condition, right? So in this case, it is subject to the approval of the alpha shareholders. Okay. Then there shouldn't be any, change in the management's intention, right? So which is unlikely because of the limited facts we cannot comment upon. So we can safely assume, yes, the management is committed, right? Buyer is actively, located. So in the facts, it is given that there is no potential buyer identified. Okay. Sale is likely to be completed in 1 year. Fact says that approval of the shareholders is not expected to be received in the near future. So if the approval is not received, then anyway we cannot offer it unless the approval is obtained, and hence we will not be able to complete the sale within the 1 year, which is the one of the condition which needs to be met. So based on the mix and match of all these conditions, we can safely assume and conclude that this is not meeting the criteria prescribed under Ind AS 105, and hence this is not regarded as the disposal group. Not regarded as the disposal group. Is that clear? Second one, PQR has entered into a contract to sell the entire delivery fleet of vehicles operated from its warehouse to a competitor ABC on 14th March 2001. So PQR has entered into a contract to sell the entire delivery fleet of vehicles operated from its warehouse to a competitor ABC on 14th of March 2001. The assets will be transferred on 28th April 2001, from which date the group will outsource its delivery activities to another company, LMN. So these are the limited facts. What do you think? Based on these limited facts, whether this forms the condition of classifying it as a disposal group under 105? So the entire delivery fleet is being, what offered under this facts. So PQR's fleet is classified as held for sale because it constitutes a group of assets to be sold in their present condition, right? And the sale is highly probable at the reporting date as the contract has been entered into. So contract has already been entered into with the buyer. It means the sale is highly likely to be concluded, and the price, certainly if the contract is agreed, entered into, then it means the price negotiations have already been completed, right? It means it was actively marketed at the reasonable price, right? Management is not withdrawing from its commitment. The sale is bound to happen in the April, right? So looking at all these conditions are being met, it can clearly be classified as held for sale under Ind AS 105, right? Third one, on 16th of January 2001, DEF's management and shareholders approved a plan to sell its retail business in Mumbai, and a consultant is hired to manage the sale. So 16th of January 2001, what is happening? DEF management and the shareholders approved a plan to sell its retail business in the Mumbai, right? So Mumbai based retail business vertical is being planned to sell. The consultant who will be managing the sale is also hired by the management. On 31st March 2001, agreement had been signed, although the due diligence and the negotiations of the final terms are still in process. The transaction is expected to be completed in April 2001. So on 16th of January 2001, the plan is proposed. Third party consultant is hired, right? Negotiation is in the final negotiation of the final negotiation, and the final terms are still in discussion. Due diligence is happening underway, right? And the management expects the sale will be completed by the end of the April. So how much period is there from 16th of January to April? February, March, April, 3 months, right? Which is less than 1 year anyway. So the sale is expected to be completed within 1 year. The answer is yes. Whether it is being actively marketed, yes, because the consultant is already hired. Whether the reasonable price is the expectation, yes, because negotiations are happening and they are in process. Due diligence has already started. It means the buyer is also serious to acquire, right? Management is committed. Yes, management is not looking to withdraw this plan because there is no such facts mentioned, and the shareholders approval has already been obtained for making the sale happen. So all these conditions are met, and basis on the combination of these conditions, we can conclude clearly that yes, this is meeting the requirement to present that as held for sale, right? So in this case, DEF sale of the retail business will not be completed until the final terms, example purchase price, are agreed. However, the business is ready for immediate sale and the sale is highly probable unless other evidence after the reporting date, but before the financial statements are approved for issue, comes to light to indicate the contrary view. So until then, we can conclude that yes, this is meeting the conditions of Ind AS 105 to present them separately as held for sale. So basically, what was the key learning from this question? So the key learning is that we shouldn't be going by our gut feeling. We would be giving the more weight to the facts of the questions rather than forming up any assumptions on our own, right? So we wouldn't be forming any assumptions on our own. We would be reading the facts carefully, analyzing those facts in the light of the 6 conditions which are prescribed by Ind AS 105. If those 6 conditions are being met and none of the 6 condition is violated, then we can safely conclude yes, the transaction is meeting the criteria of Ind AS 105 requiring the separate presentation, right? If any of the conditions among the 6 is not meeting, then it means the criteria are not met, and hence it would not require the presentation or a measurement under Ind AS 105. So 105 will not be triggered. So all the 6 conditions are to be carefully analyzed basis on the facts given in the question without forming any of the opinion on our own. So that's the key to see the Ind AS 105 application on the real life situations. right? Anything anybody wants to ask? I can wait for a minute or two. Okay. So what I'm going to do, let's start with the question number 4 now. And after this, we will take the break. Okay. So question number 4. X Limited acquires B Limited exclusively with a view to sale.
Progress.
Ashokji, break started. I hope you displayed the break. Okay, so we were talking about before we went on the break about this question number 4 facts. So we have read it out. Now we'll see if you have solved it. We will discuss the solution and you can match whatever you have come across. So I will reread the question once again. X Limited acquires B Limited exclusively with a view to sell, right? So the purpose of acquiring B Limited was to sell it in the near future, right? And it meets the criteria to be classified as discontinued operation as per 105. That is the fact given in the question. So additional information is fair value of the total assets excluding liabilities on the acquisition date is 360. Cost to sell is 10 and fair value of liabilities is 80, right? Now, fair value of the total assets excluding liability on the reporting date is 340. Okay. How the discontinued operation pertaining to B Limited should be measured in the consolidated financial statements on the reporting date. So that was the ask. Now, let's see how we are going to answer in the examination. So sometimes the questions are very straightforward and simple, but the marks in the examination depends on how we articulate our answer, right? So we need to be articulating the answer well. So IND-AS 105 defines a disposal group as the group of assets to be disposed of by sale or otherwise together as a group in the single transaction, and the liabilities directly associated with those assets that will be transferred in the transaction, right? So 105 has given a definition of the disposal group. What do we mean by the disposal group? The disposal group is the group of assets to be disposed of by sale or otherwise together as a group in a single transaction, and liabilities directly associated with those assets which are forming part of the disposal group, right? The group includes goodwill acquired in a business combination if the group is cash generating unit to which the goodwill has been allocated in accordance with the requirements of the paragraphs 80 to 87 of IND-AS 36 impairment of assets, or it is an operation within such cash generating unit, right? So if there are any goodwill forming part of the disposal group, that will also be considered, right? In the given case, B Limited has exclusively acquired, B Limited is acquired exclusively with a view to sell, and it meets the criteria to be classified as discontinued operation, right? The discontinued operation will be measured as per IND-AS 105, that is the carrying amount or the fair value less cost to sell on the date of the classification, whichever is lower, right? So entity shall measure the non-current assets or the disposal group classified as held for sale at the lower of its current carrying amount, number one, and the fair value less cost to sell, number two, whichever is lower, right? So in this case, the newly acquired asset or the disposal group meets the criteria to be classified as held for sale, right? And it will be measured on initial recognition lower of its carrying amount. Had it not been classified, so classified, for example, cost or the fair value less cost to sell. Hence, the asset or the disposal group acquired in a part of the business combination shall be measured at the fair value less cost to sell. Now, once we arrive at this conclusion, then we will measure the fair value less cost to sell. So fair value in the question is given 360 for the assets, right? And cost to sell is given at 10. So 350 would be the fair value less cost to sell of the assets, and the fair value of the liabilities is also given 80, right? So fair value less cost to sell for the assets is 350 and fair value of the liabilities acquired is 80 at the reporting date in line with paragraph 15. So we don't need to remember or mention the para numbers in the examination. That is not the requirement. But if you mention it, then please be 100% sure that you are mentioning it correctly, right? Because in the institute examination suggested answer, there will always be para number just for reference. But if you mention it wrong, then probably there are chances to lose the marks. So I advise, if you remember 100% sure the correct para number, then only mention, otherwise skip. You can simply say as per IND-AS 105, right? X Limited will remeasure the disposal group at the lower of its cost or fair value less cost, which will be calculated as follows. So the revised fair value is 340. cost to sell continue to be the same. The 330 would be the revised fair value less cost to sell, and 80 fair value of the liabilities continue to be the same. So this is how we are going to present our answer for these questions where, although the calculations are very straightforward and simple, but examiner wanted to check how well we are able to articulate, our answer and substantiate it with the reference to the Ind AS, right? So although we know the concept, we can apply it, but we also should be able to learn the skill to articulate whenever in the examination that is the ask in the question. At the reporting date, X Limited shall present these assets and the liabilities separately from other assets and liabilities in the consolidated financial statements, right? Or what will come into the P&L? The 20 rupees loss. That is the original date, classification date, fair value less cost to sell, and the reporting date, fair value less cost to sell. So 20 rupees is the loss we are incurring. So this 20 will go to the P&L, right? And where it will be parked? Continuing operations, discontinuing operations, normal, continuing operations, right? So that was it on this question. So the question looked very straight and simple, but the idea behind this question was to test our articulation abilities as well around the Ind AS and how well we are able to discuss the relevant aspects from the Ind AS to substantiate the answer, right? So it was less about the calculation, which is very easy and straightforward, and more about the articulation of the relevant aspects of the Ind AS. Right? Any questions on this? Okay. Let's move to the next question. Question number 5. So this is the information given to us in this question. So disposal group is containing all these assets. So goodwill is there, property, plant and equipment carried at the revalued amount, building carried at cost, inventory and investment in equity instruments, right? So these are the 5 items forming part of the disposal group, right? And the carrying amount at the reporting date before classification is held for sale. So immediately before the classification, right? What are the carrying amounts of these items? These are the carrying amounts, and carrying amount remeasured immediately before the classification is held for sale, right? So these are the original carrying amounts, and these are the carrying amounts immediately before the classification, that is on the date of the classification itself, basically, right? So which all items are altered in terms of their carrying amount? So goodwill remains constant. PP&D is 4600, now it is 4000. 5700 building is same. Inventory is also changed, 2400 to 2200, and investment in equity is also changed, 1800 to 1500, right? The entity estimated that the fair value less cost to sell of the disposal group amounts to 13,000. So apart from the carrying amounts on the date of the classification, which is given in the question at 14,900, the fair value less cost to sell of the disposal group is also given, which is estimated at 13,000, right? So this is the value, fair value less cost to sell measured, given in the question. Determine the loss on the measurement of the carrying amount of the assets immediately before and after the classification as held for sale. Also determine the treatment oblique allocation of such loss to the net assets of the companies. Further, in the case at the end of the reporting period, the fair value less cost to sell is increased and estimated at 15,500, then what amount of reversal will be allowed and on which all assets, right? So there are 2 aspects or 2 asks in the question. Ask number 1 is determine the loss and the allocation of the same to the assets and calculate the revised carrying amounts. And in case on subsequent reporting date, the fair value less cost to sell increases from 13,000 to 15,500, then what would be the accounting treatment, right? So I'm giving you a few minutes just to try it on your own once, and then I will discuss the solution. Okay. So I'm just waiting for you to try it one on your own. I will discuss the solution anyway. Okay. I hope you must have tried this. Uh, so let's see what is the solution. So first of all, we will compare the carrying amount, that is the revised carrying amount with the fair value less cost to sell, and whichever is lower, we will measure the disposal group at that value, right? So carrying amount is given in the question at 16,000, right? Here it is, 16,000, correct? And the fair value less cost to sell is given in the question at what value? 1490, right? So these are the revised carrying amount. So 1490, right? So the loss is 1100. So first of all, we would be recognizing this 1100 loss, right, in accordance with the applicable Ind AS immediately before classifying as held for sale. What is the applicable Ind AS here? So applicable Ind AS is basically, as I mentioned you before, that we need to compute the carrying amount as on the date of the classification before, right? We compare it with the fair value less cost to sell. Now, carrying amount on the date of classification immediately before putting it as held for sale needs to be measured so that we can compare it with the fair value less cost to sell on that very date. Now, how do we measure? So for goodwill anyway, there wouldn't be any measurement under any standard except under Ind AS 36. So Ind AS 36 says that goodwill has to be tested for impairment, right? So we will do the impairment testing, and in case there is any impairment, then we will record that loss. Otherwise, the goodwill will continue to be at the same value, right? So which is anyway given in the question. So we might have assumed that there was no impairment on goodwill. Then for property, plant and equipment, what adjustment would be there? So if the PP&E was carried at 4600 and now it is remeasured on the date of the classification, then one adjustment is the depreciation, right? Another adjustment possible could be impairment, right? So depreciation and impairment, right, could have been the two adjustments which might have had happened, right? And hence bringing the amount from 4600 to 4000, which is also given in the question. Building carried at cost. So 5700, 5700. I'm not sure why the depreciation has not been, given effect. So because the information given in the question, we cannot challenge, right? So we can safely assume that building 5700 is the right amount on the date of the classification. Then inventory, cost or NRV, whichever is lower, might have been remeasured under the Ind AS 2, and 2200 is offered as the carrying amount. And the investment in equity shares might have been measured at fair value through PNL or fair value through OCI, whatever, right? So basis on the market value, the 1800 has moved to 1500, right? So these are the revised carrying amounts given in the question. So we are not going to challenge, we are simply accepting them on the face value, right? So basis on this, the final carrying amount of the group is 14,900, and hence we will record a impairment loss of 1100 anyway on this, right? Now, the difference of 1100 reflects routine accounting entries such as revaluation, depreciation, impairment, etc. The amount shall not be considered as the impairment loss, right? So this is the routine adjustment to the carrying amounts, right? The entity estimated that the fair value less cost to sell of the disposal group is now 13,000, right? So the entity has classified the disposal group as held for sale. It should measure it at lower of its carrying amount on the date of making such classification, and the fair value less cost to sell, which is also given in the question, 13,000. So lower is 1490 versus 13,000. So 13,000 is lower, right? So 1900 additional loss has to be recognized on these disposal group asset items, and this loss will be recognized as an impairment loss, right, when the disposal group is initially classified as held for sale. Now, how this 1900 will be recognized and allocated, right? So that we also need to discuss. The inventory and investment is measured as per the Ind AS 2 and 109 at not more than the fair value at the date of the remeasurement, that is immediately before the classified as held for sale. So the impairment loss of 1900 is allocated to the remaining assets in the proportion to the carrying value of other inventory and investment in equity. So investment and inventory and investment in equity are anyway remeasured under Ind AS 2 and the Ind AS 109, right? So they are not affected by this loss. So this 1900 has to be applied on other non-current assets. What are those other non-current assets? So other non-current assets is number one, goodwill. Number two, property, plant and equipment. Number three is the building, right? So among these three items only, we will be allocating this 1900. So my original carrying amounts on the date of the classification given in the question is 14900, and I will allocate this 1900 in the ratio of these three, right? So the total of these three will be in the denominator, and one by one, 1500, 4000 and 700 would be in the numerator, and accordingly this calculation will be performed, right? So 1500, 235 and 165 and 235. Now the only rule is, because among these three items, one item is the goodwill, right? So goodwill is always eliminated first in full, right? Only the remaining loss is pro rata. Had it been some other set other than goodwill, then the pro rata would have been in the three ratios. But since we have the goodwill, and rule with the goodwill is that goodwill will always be eliminated in full in first. So goodwill will be given a first preference. So 1500 out of the 1900 will be allocated here, right? And goodwill will be 0. Now the remaining two assets are only would be pro rata, getting the pro rata allocation of the impairment loss. So if this was not goodwill or some other asset, non-current asset, then this 1500 wouldn't be allocated first to it, right? So all three assets would have been pro rata. But because we do have the goodwill in the disposal group, so please bear in mind, whenever we have the goodwill in the disposal group, the loss first gets allocated against the goodwill to make it completely nil. And remaining, if any, will only be allocated, right? So this is how the revised balances will be computed, and the carrying amount stands at the 13,000 all in all for the group, right? So the same explanation has been offered to substantiate whatever we have done in the question. So firstly, the impairment loss reduces the amount of the goodwill in the disposal group. Then the remaining impairment loss is recognized to other assets on the pro rata based on their carrying amounts, right? At the end of the reporting period, the fair value less cost to sell is increased and estimated at 15,500. Now, this is the second part of the question. So when the initial fair value less cost to sell was 13,000, and on subsequent reporting date, now it is being increased to 15,500. Then what will happen, right? The maximum impairment loss reversal allowed will be 1900, being the impairment loss recognized earlier. So this cannot go beyond this loss, right? So 1900 is the maximum amount that can be reversed. But now how much reversal is required in this question? So 15,500 minus 13,000. So 2,500, right? Although the fair value less cost to sell is coming higher as compared to what the original loss had been recognized, 1900. So we will restrict it up to 1900 only, right? And reversal of impairment on the goodwill is not allowed under the Ind AS 36 impairment of other assets. Now, although the question, whatever the question has asked for, the solution is completed over here, right? But I would like to touch upon on few more aspects, what we have learned in this question. So in this question, the key learning which we have learned is, if subsequently on each reporting date, when we are remeasuring the disposal group at the fair value less cost to sell, and suppose the fair value less cost to sell is started increasing on subsequent dates, then the original classification date loss would be the maximum amount which is permissible for the subsequent reversal all in all, right? So it cannot go beyond the original date loss which we had recognized, which is 1900 in this case, number one. So because we are seeing that as per the revised fair value less cost to sell, the gain is 2500, but we will not recognize the entire 2500, and we will restrict to 1900 the original loss on the classification date which was recognized, number one. Number two, Because this loss had already been applied on the individual assets to revise their carrying amounts, including one of the asset was in the group goodwill. So on goodwill, impairment loss can never be reversed. I hope you must be able to recall this from our Ind AS 36 discussion, right? So under Ind AS 36, it is clearly prohibited that once the goodwill is impaired, it cannot be restored back. Is that clear? So that's the rule given under Ind AS 36. So any impairment loss which was recognized or charged against goodwill, even on subsequent dates, if it reverses, so it will not be reversed for the goodwill at least. So goodwill will continue to be impaired. Once impaired, always impaired. So note down on your notepad somewhere for goodwill, goodwill once impaired, always impaired, can never be restored back, right? Now, how much loss out of the 1900 we had applied on the goodwill? 1500, right? So how much the remaining loss? 400. So the only 400 loss which we had, applied on the remaining assets can be reversed now, right? On those assets, right? So that would be the second piece. So 1900 can never be reversed, right? Again, one more thing, because we are reversing the impairment because of this Ind AS 105 virtue, right? So if there is any reversal happening, so where it will go? So reversal will also go to the P&L. Likewise, the loss was going or recognized in P&L. Is that clear? So these are the key learnings which we are learning from doing these practicals. And because we wouldn't be having that luxury time during the examination days to do all these practicals, so I strongly advise everybody to record or register these key learnings somewhere, so that you can do a quick revision in your examination days. So that's the key to revise the key concepts quickly. Okay, anything anybody wants to ask, I'm open to take the queries. Else I can proceed on to the next question. Okay, I see no questions are being asked in the chat box. Okay, then let's go ahead with the sixth question. A freehold property was originally acquired for 40 lakhs. Some years later, after cumulative depreciation of 11 lakh has been recognized, an impairment loss of 350 is recognized, taking the carrying value down to 25 lakhs 50,000, right? So 11 plus 3, 14 lakh 50,000 minus 40 lakhs, 2550 is the carrying amount, which represents the estimated value in use of the property. Shortly thereafter, as a consequence, the proposed move to the new premises, the freehold property is being classified as held for sale. So because the company is planning to move to the new building or new premises, so this building will not be used anymore by the company, and hence company wants to sell it. So they have classified it as a held for sale. At the time of the classification as held for sale, the carrying amount is 25 lakh 50,000 and the fair value less cost to sell is estimated at 25 lakhs. At the next reporting date, the property market has improved and fair value less cost to sell is reassessed at 2650. 6 months after the property market has continued to improve and the fair value less cost to sell is assessed at 30 lakhs. Determine the amount of the gain or loss on different reporting dates or different point in time and tell us the accounting treatment. So I'm just giving you 3-4 minutes quickly to read the question again on your own, draft your responses for each of these dates and come up with the accounting treatment. We will discuss the solution then once you are done. Okay, so we can start to discuss the solution now. I hope you must have tried this on your own and you will be able to see if you have come up with the right answer or not. So the initial round on the classification as held for sale is 50,000 and the property is carried at 25 lakhs, right? So in the question, it is clearly mentioned that 25 lakh 50,000 was the carrying amount, right? and 25 lakh is the fair value less cost to sell measured on the date of the classification. So how much the delta is the carrying amount 2550 and the fair value less cost to sell 25, whichever is lower. So what is lower? Carrying a fair value less cost to sell is lower, right? So by how much? 50,000 only, right? So 50,000 would be the loss which will be charged in P&L against this fair value less cost to sell measurement on the date of the classification as held for sale, right? So this 50,000 will be charged or recorded, right? And once the classification is done, depreciation ceases, right? This we have discussed many times today, that once the assets are classified as a held for sale, on those assets, depreciation or amortization, if there are any intangible assets part of that group, will no more be charged, right? At the next reporting date, the property market has improved and the fair value less cost to sell is reassessed at 26 lakh 50,000, right? So the gain is how much? 1 lakh 50,000, right? Is less than the cumulative impairment loss recognized to the date. So what is the cumulative impairment loss? 3 lakh 50,000 plus 50,000 on the classification. So all in all, 4 lakh was the loss which was recognized, right, on that group. So against this 4 lakh, this 1 lakh 50,000 can be restored because of this improvement in the fair value. Accordingly, this 1 lakh 50,000 will be credited in the profit and loss, and the property is carried at 26 lakh 50,000. Now, in this case, what is happening? Although we have recorded only the 50,000 loss on the date of the classification pertaining to Ind AS 105, but on the very same day, when we revised when we recomputed the carrying amounts on the date of the classification, right? So we have calculated or we have brought down the assets of 40 lakh minus cumulative depreciation to 2550, recognizing a impairment loss under Ind AS 36, right? So it is clearly mentioned that and as per the Ind AS 36, before the classification to held for sale under 105, an impairment loss of 3 lakh 50,000 was recognized on that very date. Now this 3 lakh 50,000 plus 50,000 as held for sale, right? So total loss which was recognized was 4 lakh. Now the reversal is happening only for how much amount? 1 lakh 50,000. So the reversal cannot go beyond the loss recognized, but the reversal can go up to the loss recognized, and hence 4 lakh is the threshold beyond which we cannot go, right? So until then, we can recognize the reversals of the impairment loss whenever, as and when they are accruing, right? So we will pass the entry for 1 lakh 50,000 to record the reversal of the impairment losses recognized, and we will revise the carrying amount of our items in our balance sheet at 2650 from the 25. Now, 6 months later after that, the property market has continued to improve and the fair value less cost to sell is now increased to 30 lakh, right? The further gain of 350 is, however, in excess of the cumulative impairment loss recognized to date, that is 4 lakh, right? So 4 lakh minus 1 lakh 50,000, which we have recognized already last year. So only the 2 lakh 50,000 remaining impairment loss we are sitting with, which we can reverse because of the change in the circumstances. But we cannot go beyond the 2 lakh 50,000, right? So the current reversal is coming up for how much? 3 lakh 50,000. But we cannot record the 3 lakh 50,000. We can go up to 2 lakh 50,000 only. So hence the revised carrying amount would be, 29 lakhs rather than 30 lakhs. Clear? So this 2 lakh 50,000 will be credited in the P&L only, because impairment losses are always recorded in the P&L. So impairment loss reversal will also be credited to the P&L always, right? So we will recompute the carrying amount of all our assets forming part of the disposal group, which at 29 lakhs only. That subsequently the property is sold for 30 lakhs And because now the property is anyway sold for 30 lakhs, so 1 lakh is the gain, which will be anyway recognized as the gain on the sale of the property. Right. So this is how the accounting will happen over the multiple dates. So on the very first date, we have recognized the impairment loss before the classification, 3,50,000. Then we have recognized the 50,000 additional loss under the Ind AS 105 remeasurement, right? So the total loss which we have recognized on these assets was 4 lakh. Up to the 4 lakh, impairment reversal can happen anytime in the future until the sale happens, right? So on the next date, reversal happened for 1,50,000. Then thereafter again one more leg of reversal happened for 350, but we could recognize only up to 250. And then finally we eventually sold the asset at 30, realizing the gain on the sale of rupees 1 lakh. So once the asset is sold at the higher amount as compared to the carrying amount, then whatever the delta is anyway is the realized gain. So that anyway will always be recorded in the books, right? So there is no cap or no prohibition to record that, right? But unrealized gain, just by virtue of the revaluation or change in circumstances, impairment loss reversal, we cannot go beyond the original impairment loss in its entirety which we had recognized initially on those assets, right? So that's the limitation on that. Is that clear to everybody? Any questions? Anything anybody wants to ask? I'm happy to take queries and questions. Okay, so the key learnings, what all we have learned from these questions, the key learning is before any of the disposal group is classified as a held for sale, its carrying amount has to be recomputed in accordance with the other Ind ASs. Other Ind ASs means Ind AS 16 for the PP&E, Ind AS 38 for the intangible assets, Ind AS 40 for the investment property, Ind AS 109 for the financial assets, Ind AS 2 for the inventory, or so and so forth, right? Then Ind AS 36 will also be applied to check for any impairment, if any. And if by virtue of application of Ind AS 36, any impairment loss is also recognized, that will also be recognized. And as per Ind AS 36, impairment loss first will be adjusted against the goodwill if it is sitting in the disposal group. Otherwise, it will be allocated on a pro rata basis to non-current assets, leaving the trade receivable, debtors, creditors, or financial assets aside, right? So on that, impairment loss can never be allocated under Ind AS 36, right? Once this impairment loss is allocated, the revised carrying amounts are computed on the date of the classification. Then this revised carrying amount will be compared with the fair value less cost to sell measured in accordance with 105. If the fair value less cost to sell is higher as compared to the carrying amount, there wouldn't be any adjustment required, right? Because the standard says at the lower of the two, right? The disposal group will be carried. Now, because my carrying amount is anyway lower as compared to the fair value less cost to sell, no adjustments. But if the fair value less cost to sell turns out to be the lower as compared to the revised carrying amount, which we have just computed on the date of the transaction, date of the reclassification, then the delta would be recognized as the loss in the profit and loss statement of profit and loss, right? Now, again, how this loss will be allocated. First, again, the same principle. We will apply or follow the same principles which Ind AS 66, Ind AS 36 has given. So if the goodwill is still sitting in the disposal group, then this loss again will be allocated to the goodwill first, right? If after applying it to the goodwill, still there is any impairment, any loss remaining, then it will be applied to the remaining assets on the pro rata basis, non-current assets like PP&E, intangible assets, investment property, etc. Right? And then we will compute the revised carrying amount at fair value less cost to sell under Ind AS 105. And then until the sale happens at each reporting date, we will continue to remeasure the fair value less cost to sell, fair value less cost to sell, fair value less cost to sell on each reporting dates. And if there is an increase in the subsequent on the subsequent reporting date in the valuation of the fair value less cost to sell of this disposal group, then the increase will be regarded and recognized in the statement of profit and loss, right? So under Ind AS 105, there wouldn't be any situation where we would be recording this gain or loss in the OCI. It will always go straight to the P&L, right? Now, the gain, or I will not regard it as a gain. I will regard it as a reversal of the loss or the impairment loss. It will be restricted to the maximum amount that we had initially recognized as impairment loss. It cannot go beyond that, right? So that is the another key learning which we should note down on somewhere on our writing pad for future reference and revision. And then at each reporting date, we will continue to remeasure that fair value less cost to sell. If it is coming down, we will record the loss. If it is going up, we will see whether we still have the room to record it or we have exhausted our original impairment loss. If we have exhausted, no more reversals can be recognized, right? So it will go in vain. Now, on the date of the sale, when we are actually selling the disposal group. So if my carrying amount is say 1,000 rupees and I'm selling it for 1,200, then certainly 200 is the realized gain. So that anyway will be recognized and recorded in the P&L as the gain on the sale of the disposal group. So that's all, which we have learned under Ind AS 105, which we need to remember. So all these key learnings, I hope you were making notes and noted down all these key learnings so that you can revise them quickly on your examination day, right? Now, finally, after doing these numericals, let me quickly jump on to the disclosures, right? So disclosures is also very important, right? We cannot ignore them. Okay. So presentation, we have already learned that it requires a separate presentation, right? Presentation and disclosure shall enable the users of the financial statements to evaluate the financial effects of discontinued operation, right? Just give me a second. Okay. So presentation, we have already discussed multiple times that, it requires a separate presentation either on the face of the balance sheet or in the schedule, right? Under the notes to accounts, right? Now, why it is required? Because users of the financial statement will be able to quickly pick it up that there are certain items which are classified as held for sale during the year by the management or the company, so that they can be taking informed decisions about their next action on the company, whether they are, investing or not, right? So this is that is the very purpose of making the investors, informed about these material or significant, decisions the management has taken for the future, right? Now, in the statement of the profit and loss, disclose the single amount comprising the total of the post-tax profit or loss from of discontinued operations and the post-tax gain or loss of the recognized on the measurement of the fair value less cost to sell on the disposal of the assets or disposal groups constituting the discontinued operations, right? So in the statement of profit and loss, we would be disclosing under the single line item the profit and loss which we have recognized or realized during the year from the discontinued operations. So let me ask you one question. So even if the management has decided upon to sell a particular division, right, in the near future, but until the sale actually happens, that division is still in use, yes or no? Yes. So that division might be fetching some revenue and the cost and the profit or loss for the company. Yes. So where that profit or loss would be disclosed. So that profit and loss will be disclosed on the face of the balance sheet in a single line item as the post-tax profit or loss from discontinued operations, so that users of the financial statements will be able to demarcate clearly out of the total profit or the total loss of the company, how much pertains to the discontinued operations. What percentage of profit or what percentage of loss is coming out of the discontinued operations, whether it is significant or not, so they can take a quick understanding of that. So that's the very purpose of this presentation. Now, Apart from this, the post-tax gain or loss recognized on the measurement to the fair value less cost to sell also needs to be disclosed, right? So this will continue to be presented under the profit and loss of from the continuing operations. So that you need to keep in your mind carefully, because sometimes in examination, if examination question requires to showcase the relevant extract of the P&L or the balance sheet, then you might end up doing this presentation as well rather than simply discussing, right? And if you missed to present it under the continuing operations, right, then you will lose the marks. So the standard requirement is, if the profit and loss you have earned because of the discontinued operations, that will continue to be presented under the profit and loss from the discontinued operations. But whatever the gain or loss you have recorded during the period by virtue of remeasurement of the fair value less cost to sell of the disposal group, that gain or loss will be recorded under the P&L from the continuing operations. Right? Is that clear? Now disclose the analysis of this single amount into the revenue. So these are the disclosure requirements. Now, to make the users of the financial statements, well informed, how much revenue, how much expenses, how much pre-tax profit I am earning, or how much losses, pre-tax loss I am earning from the discontinued operations, what are the income tax expense and liability for that, and if there is any gain or loss arising out of the remeasurement of that disposal group, that needs to be disclosed in disclosure in detail, right? Then present the analysis in the notes or in the statement of the profit and loss. So that is your choice. You want to present it on the face of the P&L itself, or you want to present it in the notes. That is all your choice. Disclosure of the analysis is not required for the disposal group that are newly acquired subsidiaries that meet the criteria to be held for sale on the acquisition. So if any company acquires a subsidiary with a view to sell it only, right? So then this disclosure of analysis is not required because the subsidiary is held for sale from the day one itself, right? Now disclose the amount of the income from the continuing operations and from the discontinued operations attributable to the owners of the parent. This disclosure may be prescribed either in the notes or in the P&L, right? Always, whenever there is a choice to disclose or present something on the face of the P&L or in the notes, we always choose the notes, right? Because we don't want to, unnecessarily distort the presentation of the main P&L or main balance sheet, unless and until there is a specific requirement to present it on the face itself, right? Now, what will happen in the cash flow statement? So in the statement of cash flows, disclose the net flows, cash flows attributable to the operating, investing, and financing activities of the discontinued operations, either in the notes or in the financial statements. So if there are any cash which you are generating or you are using, right, for any of these discontinued operations items, then that will continue to be presented under the operating, investing, and financing activity from the discontinued operations, or it can be separately presented in the notes to accounts. So you can prepare the normal cash flow statement like the way you are doing it, and in the notes to accounts, you can explain how much cash from operating, investing, and financing activities pertains to this discontinued operations. These disclosures are not required for the disposal groups that are newly acquired subsidiaries. So these disclosures are applicable only for those non-current assets held for sale which the company was using for the business earlier. But if the company has recently acquired a subsidiary by virtue of selling it only, right, then probably these disclosures are not required. That is the clarification from the standard. Comparative figures for the prior periods are also represented. So all the comparative figures will be continue to be represented. Adjustment to the prior period disposals. Adjustments in the current period to the amounts previously presented in discontinued operations that are directly related to the disposal of the discontinued operation in the prior period should be classified separately in discontinued operations. The nature and amount of such adjustments are disclosed, right? So if any prior period adjustments are done, those will also be disclosed in the notes of forms. So I have tried to cover the length and breadth of the concepts along with the practical applications in the practical numericals which we have done during the class. So I hope the session was informative. for all of you. So with that note, that was all from my side. In case there are any questions or queries which you want to ask, I open the forum. Okay, so looks like there are no questions or queries. I'm not seeing anything in the chat box either. Okay, then thank you for listening me patiently, and I hope you understood or revised the key concepts today on India's 105. All the very best for your examination. Have a good day. Ashokji, session is completed. Are you able to hear me, Ashokji? The session is completed. Sorry? Yes, yes, it is completed. Thank you.